Hi, Bill Bodner here, Mortgage Market Guide. Thanks for tuning in to our MMG weekly recap. So, on a week over week basis, rates pretty much unchanged, but it wasn't a straight line, a lot of volatility, and we're expecting it to continue. So, the 10-year note, we're loving staying beneath 160. That's a good thing. Stocks are going crazy. Why? Because we have this 1.9 trillion dollar stimulus plan going to be signed by President Biden after it passed the Senate and the House this week. And so, what we don't know is how this money, this enormous sum of money, seeps into the economy. Will it be inflationary, or will it not? If inflation rises, it's going to put upward pressure on rates, and it will put pressure on the Fed to do even more than what they're doing right now. So let's just take a look at the charts for a moment. You could see here the bond market is mortgage-backed security prices. They're trying to stabilize. We'd like to think that 2 Thursdays ago was the bottom of the washout in prices. Let's hope that to be true. But you can see here, even in the last 5 days, we're trading in a range between 101 and 100.50, so a narrow 50 basis point range just over the last 4 days or so. And so talking to clients, we got Fed next week, and the market wants to hear again them talk down inflation. It's not going to be a problem. I think the market needs to be hearing it and hearing. It's not buying it right now. And then also, what happens if rates tick up? What happens if the 10-year note moves above 160? In our eyes, it's going to 190 fast, and mortgage rates are going to be pressured higher as well. But does the Fed have one more tool in their box, so to speak? And I think they do, and it's probably going to be an Operation Twist 3.0. And how it works is they sell short-term bonds out of their existing $7+ trillion portfolio. They sell short-term bonds, notes, bills, things like that. And the exact proceeds, let's say 100 billion worth, they turn around and they buy the 10-year note, 30-year bond, mortgage-backed securities, and it has a multiple effects. One, it raises short-term interest rates. It lowers long-term interest rates, and it strengthens the dollar, which has a disinflationary force to it. So it wouldn't surprise us here at MMG if the Fed uses that at some point in time, because it's tough to see rates not get pushed higher. And then what I'd leave you with is that rates may not get that high near term. Why? Because of the relative underperformance around the globe. This past week, we're hearing stories of Japan and European big investors coming in and buying our 10-year note. Why? Because the yield at 160 is a hell of a lot better than what else is out there on the planet. You're looking at the German Bund at minus 33 basis points, and the German government bond at 0.1%. And so, our rates look pretty darn good. So all in all, it was a pretty good week with the markets trying to stabilize, but we have to watch the Fed, inflation, and the buying that's now happening of our bond market right now, because it's given us a little bit of rate relief, which we needed. Hope this finds you well. Have yourself a great weekend. Talk to you soon. Bye for now.